Hello.
Hello.
Hi. How are you, Christina?
Oh, thank you. How are you?
Good, good. Finally, the weather changed. It was crazy for past few days or so.
Good afternoon.
Good afternoon, Steve.
You guys hear me okay?
Yeah. Hey, Steve, how are you?
Can you hear me?
Yeah.
Yes.
Can you hear me? No? Yes? Oh. Okay, how about now? You guys hear me okay?
We can hear you, yes.
Okay, great.
Yeah.
Hey,
How's it going?
Z, exciting news. We're moving forward with the Opal, and I know that you're going to be helping raise some capital here. So if you could reach out to Charlie.
Charlie?
Yeah, Charlie's on our team. He's with Saber Equity.
Okay.
And if you get with him, why don't you guys coordinate something with the EMD partner?
I got it. Okay.
Okay.
If you can send me information, I'll contact him and then I'll jump on it right away. I talked to Kyle yesterday too. So it's a good stuff. So yes, I'll be on it right away.
Yeah, so I'm just sending you a message now to call Charlie, and I just sent you a group text between you and him.
Okay.
Exciting.
What about the Sacramento? How's that going?
Well, we've kind of run into a bit of I would not call it an insurmountable roadblock, but it seems that there are some impact fees that were not calculated in the initial underwriting.
Oh, okay.
And so we have a partner that we work with in this industry, and they've looked at this deal before, and they feel like with the impact fees, our ceiling purchase price should be around 11.5.
Okay.
So I mentioned that to Michael Yu in discussion with the fact that Dan has been indisposed on jury duty, but we're looking at maybe having Dan coordinate a time for us to have that deeper discussion, because ultimately I think we're the best buyer for the asset. I know the seller wants a little more money, but he's not going to get any more money, and there's not going to be a buyer that's going to out necessarily bid us.
I think so. Yeah.
And I think 11.5 is a very fair price for that asset, considering they bought it for 6. They put 2-3 into it. They've had it for a few years. Yeah. So that's, I think, where we stand on that project. I think that we just let that sit for a little bit and let the seller think about it, and we follow up, have Dan follow up on a regular basis.
Okay. I was actually looking into a hotel here in Sacramento, but it's a smaller deal, Steve. It's like only 40 units though. They're already planning to do a conversion, but I looked at it, it's only 40 units. So I didn't reach further because there's only 40 units. It's a midtown.
Yeah, it's just it's difficult to get something to pencil on a conversion when it's of that size, because of the amount of capex. You really need the large rental count, right? And so not that we won't do it, but we the absorption rate is going to be super strong. Hopefully there's some kitchenettes inside of the hotel rooms. The lift is not as severe, it's not as heavy, right? So It's a case by case. Also, it certainly would help if the seller would be open to doing some type of carryback, et cetera, et cetera. So, the flexibility on terms may offset the unit count, but typically I like to look at 100 doors or better.
Yeah.
And it's not necessarily to go big or go home, but it's really just the economics or the economies of scale. Smaller hotels, if you try to make them pencil with all the capex, it's hard to get out of that hole. It'll take 3-4 years and almost too long to have it make sense. So you really want to see returns that are super generous for your investors to make the project a super success, and go for the bigger hotels, the bigger hospitality assets.
This one lead, actually, I got it last night. I think it was in the market. It's almost 110,000 square feet. It's an office. Christina, can you pull that up?
Sure.
Which one? The one that you sent me earlier?
Marconi, yeah. Is it Marconi? Yeah.
Did you do any research on the zoning?
I was going. That's why I asked. Because I was talking to him this morning. He said it's cup, so I still have to contact the city. So I'm not sure.
Why don't we hold off on reviewing that until we get confirmation on the zoning?
Okay, let's do that. Okay.
Yeah. So let's talk about stuff that has already been vetted. And
Right.
Okay,
it makes sense.
vetting. Yeah. Therefore, we can kind of move the call along. And so today is, I think, first half of the call. We're going to look at a few hospitality assets. Christine, you want to share your screen and we'll share some hotels that we reviewed this week. And that's what we do every week. We look at hospitality, retail, and office to convert into either multifamily and or self-storage. And so every week we're going to review some new opportunities, and we ask for you guys to do the same. If you see an opportunity out there that would be a good fit to be converted, push it forward, and we'll review it on the following week's call. So let's see here. We're looking at this opportunity in Days Inn Daytona as an extended stay. Christina, do we get the final OM from the broker?
Not yet. He just gave me some of the information for this property.
This is something that's kind of new, kind of shows you the process of how we evaluate a conversion opportunity. So let's go on to the next slide. Thank you. So built in 67 is kind of the sweet spot for hospitality conversions. Anything between 1960 to 1980 is kind of that sweet 20-year period. So it's old enough where it doesn't make sense to try to renovate it and use it as a traditional hotel unless it's something, antique or in a iconic area or on the coast. But generally speaking, if you ran a search and looked for hotels 100 keys or more built between 1960 and 1980, this is kind of the sweet spot. So this 138 keys, it's a package deal on 7 acres. Next slide. And here are the two assets that we're looking at. Let's see here. Again, the text is a little small. Can you zoom in a little bit, Christina? Or I need to go through LASIK surgery yet again. I did it like 12 years earlier. Maybe it's time for a refresher. Is there any way you can zoom in there? Or is it kind of set on a... Anyways, I can struggle, but yeah, there we go. Can we zoom in? No? Possibly?
Let me...
So it's not so difficult to view. Maybe in the future, let's figure out how to get a bigger font, but I can struggle through this one. So 72 rooms on the property on the left. This is the Days Inn Daytona, built in 67, 2-story exterior hallway, 100 spaces. So a 1.3 ratio on parking to units, which is not bad. Could be better, but something that you guys want to pay attention to. Parking is always an issue. Yeah, and then of course the next property is the one on Ormond Beach, and that one is also built in the same, it's kind of a little blurry, but built in the year that I was born, 73, so 50 years young, 66 rooms, 74 parking spaces. And let's go on to the next page. Should we start any underwriting or?
Yes, we did.
Perfect.
I did.
So here's some area analytics, something that you guys want to pay attention to, kind of to check the first 4 boxes. I like to look at the 12-month absorption of units. Not the best of numbers. That looks like a -26. So we may want to dig in a little deeper. It does have a 5.9% population growth over the next 5 years. I do love Florida. And as far as the rental rates, we don't have studios. So I think, is this in an area where we're having some difficulties pulling comps, Christina?
No, the other one,
The
not
other
this
one?
one.
Okay. And so we're going to exit per unit at 196. So that's a great exit price. Let's go to the next slide. All right, so there are the 2 properties. They're adjoining one another. This would be a great portfolio product to be presented to investors. Here, back up one.
Sorry.
Oh, where are you going? As you look at this aerial overview of the property, you can kind of envision how the properties could potentially share amenity space between the units. You could also look at potentially collapsing some of the hotel units and making larger 1-bedrooms, depending on what the market demand is. It has amazing frontage as far as appearance on that 95 freeway. So you can see the signage is right there overlooking the freeway, which is amazing. I do see a pool, and on the back side of the property, that would be a great area to add some self-storage and to increase the NOI. And the roofs, they look a little haggard, so definitely would advise having a site visit and getting a general contractor out there. But roofs look like they need to be replaced, and the asphalt looks like it's in decent shape. And the landscaping looks like it's in decent shape. And who knows, maybe the Econo Lodge next door wants to sell as well. So if we were to pursue this, as I was doing my site visits, I would literally set up an appointment with the owner of the Econo Lodge, and I would try to lock up all 3 properties. So kind of on the early stages of vetting this opportunity. So we'll have more information on this for next Thursday's call, but let's go on to the next slide. And here is some exterior pictures. The properties look like they're in decent shape. Again, 1960, 1970 builds, perfect for converting to multifamily. You'll see that portico there on the left. We're actually reusing that structure on another conversion in Jacksonville, Florida, where we're enclosing that structure and turning that into an amenity space. So rather than taking down what would be, a fairly expensive demo bill, and of course it does give you the resemblance of a hotel, but then reusing that space and enclosing that, you can turn that into a rec center, rec room, sitting area, amenity space. And we have some visual renderings we can share on next Thursday's call on one of our conversion projects, so you can see some architectural drawings on some projects that we're currently working on. Next slide. Here are the 2 properties. Next slide. As days in, we got some rental comps. The prices per square foot are kind of rangy, but definitely positive. And again, this depends. We're about 9 miles outside of Daytona Beach, so in a tertiary area, but I would consider this an emerging market. If Daytona continues to grow as fast as it is, these smaller markets will see that expansion. So if you were looking at conversion projects, sometimes being in these tertiary cities outside of an area that's experiencing growth will help bolster your returns exponentially by just the means of population growth that you didn't even initially account for. Does that make sense? Whereas on the inverse could be true, you could be looking at a hotel at an area where there's a mass exodus, and that's a project you don't want to get yourself involved with. So like they say in real estate, it's location, location, location. Nail those factors down and see if this is an area of growth or decline. Next page. And do we have a purchase price? What's the reason for the negative returns?
The purchase price is 11 million.
Okay, got it. So that they want how much per door? What is it, 70, 80,000 per key?
Yeah, 79 per key, 79,000 per key.
Okay, and then did you see it? Does it pencil for 50,000 a key?
It doesn't pencil at 50,000 a key.
Not even 50,000 a key?
Not even 50, yeah.
Got it. All right. Is the seller interested in doing any carryback?
Yes. Yes, there's an email that the seller is willing to have a carryback. And I was setting up an appointment for you and the broker to negotiate on this deal. Yeah.
All right. So as you can see, sometimes, hotel operators will come to market and they'll have a wish price, right? And it may not be a realistic price. But by doing an initial analysis, you can kind of show the hotel operator / owner, like, this is the reason for my offer. I believe you're not going to see anything greater, and here's why. Can we talk about maybe doing a joint venture or doing a seller carryback, where even if they weren't wanting to be in second place behind a primary loan, they can come in as a joint venture and put in their equity towards the deal. So that's a way for them to maybe see, not necessarily initially their purchase price, but if they were to do a 1031 exchange, roll some of their equity in the conversion project, they could potentially double their investment on whatever they decide to roll into said project, if the numbers made sense. So, so nothing ventured, nothing gained, but that's kind of the next conversation I'll have with the broker and see if there's a possibility there. Any questions so far? Moving on to the next hotel. I think we have 2 or 3.
Yeah, we have 2.
I think we analyzed like 3 this week. What's the next one? Any questions while Christine's pulling that up?
Hey, Steve, if you ask the owner to carry the loan, does it? I mean, basically, you're asking that they can still get the same price, but carry the difference on the second, or could be a joint venture, correct?
Yeah, more than likely, they would not want to be in secondary position because of it being a conversion project. You're going to get a construction loan, so they would almost be in like third position. So,
right.
And there's a lot of risk because we're essentially tearing the asset down to the studs and converting it to multifamily. So their best bet to get them protected is to come in maybe as a limited partner and or a joint venture and have their equity roll into the project as a general partner of some sort. So that would be probably the best avenue for this, only because I've tried the other areas, and because these are heavy lifts, the secondary construction loan poses a problem for anyone who wants to do a carryback, because now they're in third position. Does that make sense?
Okay. Yes. Okay.
So we're expanding our reach, kind of looking in North Carolina, and came across this asset, the Clarion Lumberton. I don't know where Lumberton, North Carolina is personally, but I am familiar with the state of, and North Carolina being a strong market to invest in. We went ahead and looked into this property. Let's go into the next slide. Built in 1970, it's been renovated in 2022, 101 keys, exterior corridor on 4.3 acres. Zone B5. Christina, do you know if that was allowing for multifamily, the zone B5?
I am still waiting for the confirmation because I called this morning. I called the city this morning and I have a call back.
Okay,
I'm waiting
great.
for a call back. Yeah.
Yeah, as we underwrite properties, it's always best to kind of, get your feelers out there, call city planning, and if not, get on Google and do a Google search, and you can actually pull the zoning, and if you'll get the information either in CoStar, or if it's listed on LoopNet, always research that zoning and see what you can do with that property. Asset repositioning is our specialty. In order for that to be a reality, you have to figure out, one, is it possible? And if two, if it's not currently zoned for what we want to have as end use, which is multifamily, then inquire to see if it's open to being rezoned, right? So that's a process, one of one of which can be, somewhat lengthy, but very financially beneficial if you get, that approved. Any questions there? Next slide. So opened in 1970, and let's see, it was best renovated in 2019, 101 rooms, great parking. Looks like it's got 200 surface spaces, so super excited about that. On 4.3 acres with a pool and a business center, so certainly want to consider amenity space when looking at these hotel assets, is because these are smaller apartments, you want your tenant base to have a reason to stick around and have some outdoor amenity space for them to stretch their arms and enjoy the area in the complex, and certainly helps to demand a higher rent if you have more amenities, and it's more value add to the property. Next slide. So, exit price is kind of low. It's a small city in North Carolina. I'm not sure, looking at the population growth and what they're anticipating in the next 5 years, these are negative numbers. So we're seeing an exodus in this market. So even though the asset looks promising, it's got plenty of parking, as an investor, you're going to have these, conversations with your own investor pool. And if you're not excited about the area, it's going to be difficult to get investors excited. And it's going to be, the first question they're going to ask is, what's the absorption? What's the population growth in the next 5 years? And we're seeing negative numbers, right? The rents are kind of low in the studios, and the exit price per unit is kind of on the lower side. So looking at this, I believe we did some underwriting, Christina.
Yes, we did.
Yeah, and I think we were decided to pass, and it did not pencil.
Yes.
So I think it's important to show everyone, deal flow and how to evaluate these opportunities quickly and efficiently without getting bogged down in the minutia. So therefore, you can take that sniper approach and focus in on the deals and markets that pencil and check these immediate boxes. Next slide. Here's kind of an overview of the area. Great location, it's just too small of a market, and I don't see a lot of population growth happening in the next 5 years. Who knows, something may change. But gotta love the infrastructure. Next slide. And here's some exterior pictures. Great looking asset. Again, great location. Not something that we want to pursue. The market's just too small. Next slide. And here's our numbers. Those red bars mean no go. So 2 reds is a no go. And what we look at when I say reds is anything north of 30% on the internal rate of return is a green bar, and anything north of 75% capital return is a green bar. So it's going to be north of 75% if I'm going to be able to get my refi capital back within 2 years. And this was underwritten at a purchase price of $5 million. Next slide. Here's our overall analysis. Underwriting doesn't pencil, negative absorption rate, population growth is negative, rents are low, market sale price per unit is low, which is a positive. Out of those 5 bullet points, that's the only positive. They all need to be positives for us to get excited about moving forward on a heavy lift conversion project. Next slide. All right, I think we have one more.
The other one is not yet, is still, I'm still working on the underwriting for that.
Let's
The
pull it up. And we can
143.
kind of we'll tee it up for now. Finish off my segment, and we can finish off with that next week. While Christina's pulling up this next hotel that we're looking at, just an update on the Opal Hotel in Altamont Springs. Really excited to share the news with everyone that we're moving forward. We're currently under LOI. The attorneys are hammering out the PSA. We should have that finalized and under contract next week. So this is a 260 room hotel that's going to be converted affordable housing to 260 multifamily units. Purchase price being $19.4 million with an exit of $62.4 million in 5 years. So inching forward, excited that we're able to get the seller to agree, most importantly, to the contingency on the change of use. They agreed to 6 months. We've been told by our land use attorneys that it could take anywhere between 4 to 6 months. The seller verbally talked about potentially giving us some additional time. So we're just baking in those 3 additional 30-day extensions at $25,000 per extension, going hard upon use of said extension. But these are just all kind of fine-tuned details to get this, squared away. So excited about that. I think. Do we have one more hotel, Christina? We're able to pull up that last one that shared by? Let's see here.
I'll show you the information from CoStar. Give you one second.
Let's look at the property summary. So Bailey Mason shared this property in Indianapolis, Indiana. Listed, not yet listed, but I guess anticipating going on the market for 1.55. It's 148 doors.
Yeah, this is my deal I was telling you about. My
Hey,
wife
Travis.
is Bailey.
Okay, got it. So, looking at CoStar, I noticed that it said 80 doors. So you confirmed that it's actually 148 keys.
That's right, 148 keys. However, they've been, the units themselves, I guess, have been joined together in one building.
Got it. So it was originally 148, but then he collapsed it down to 80, and that's what we're seeing now.
That's right.
Got it.
Yeah, and I spoke to the owner of the hotel.
Got it. Okay. And so are you thinking about going back out to the 148 keys and keeping them as micro studios at 265 squares each?
It depends. So when I talk to city planning, it depends on what the space will allow, what they'll approve.
Yeah.
Given that it's like 3-4 acre, 3.4, 3.7, I can't remember.
Yeah.
And they said that we need to have some common area space exterior wise. So based on the number of units or occupants. So I'm not sure what would be the best number, but my plan, given the area, is to go some sort of subsidized housing, affordable housing plan, just because Indy's big on that right now, and in the area, it would definitely warrant that type of clientele.
Great.
Which I'm not sure if they'd want micro studios with kitchenettes, or they would want, some 1 bedrooms, or if a mix would be the best option.
I mean, push for micro studios if you can, right?
Yeah.
So if you do so, you'll be able to keep that door count of 148, which certainly would help your penciling, your underwriting.
Yeah.
So try to get his way as with as many potential doors as possible.
Mhm.
and then just reverse engineer backwards from there.
Okay.
Yep. And see what you can get approved. I mean, every city is different. Sometimes they have requirements on density counts, so the number of units per acre. Sometimes they have requirements on unit size, and sometimes they have requirements on the number of parking spaces per unit. And so each one of those could hang up a potential conversion project. So make sure you get those 3 boxes checked.
Okay. All right.
And then if you can maximize to 148 and you realize that lower purchase price, then, as far as outdoor amenity space, you can, throw in a dog park, you can enclose that portico and turn that into amenity space. Obviously you have the lobby, et cetera, but you can get pretty creative pretty quickly depending on, what they're looking for as far as their minimum requirements, as far as amenity space for an affordable housing multifamily solution.
Okay. Yeah.
Right? Because you're
Yeah.
multifamily is one thing, but affordable housing, in multifamily is just another subset below that. Or not below that, but
Understood.
another subset, right?
Yeah.
All right. And then so I think Christina is going through the underwriting process now. And we'll how far along have you got? Did you get the rent comps by any chance?
Not yet, because I'm still searching for the room sizes
We'll go
in
to
the rent
265.
265. Okay.
Yeah, go 265 times 148, and then just look for micro studios in the area using Rentometer, and then get the rental price per square foot, and then let's get the underwriting started, and then next week we'll review this on the call, and we'll share what we found and send that over to you, Trav.
That sounds good. I know the area well. I used to work a quarter mile away.
Okay.
So I know the area really well, and the units themselves are 12 by 22.
Perfect.
So that's and again that was banking on them being at 148 total.
What's your end goal? Are you looking to take this down yourself? You looking to JV? You want to syndicate?
I'm looking to JV and learn the process coming from the single family double world, looking at multifamily, and then this hotel conversion is pretty appealing.
Well, we have the staff and the experience and the manpower to help you out. So let us know how you'd like to get us involved. And like I said, we'll underwrite it and see first and foremost if it pencils.
Yeah, that was my question is, I'm not sure how exactly to underwrite it. How does it pencil the same in terms of the CapEx? I know planning said it could take 3 to 4 months just to go through the planning process. It's zoned C4 now, which doesn't allow multifamily, but the city is willing to do something in that area for multifamily, just considering the density there.
Yeah, we'll just need to ensure we build in contingencies, and I'll show you how to do this with the LOI submission to ensure that we get that approved prior to closing.
Okay.
Yep.
All right.
But I'll walk you through all that.
Yeah, that'd be great. The underwriting, I'm concerned about how to build in the
first
the
things
cost.
first is
Yeah.
we're gonna guesstimate on the CapEx based upon project experience.
Mm-hmm.
And we're going to err on the side of caution and go higher, right?
Right.
And then anticipate probably some amenity build out.
Mm-hmm.
And then that's what we'll come up with, and I'll share that with you, and then I'll share that on the call next Thursday as well.
Yeah, it sounds good. Yeah, I'm excited to see what it looks like.
My pleasure. That's what I love doing. All right, I think that's my first half. Thanks to everyone for joining, and Nick, why don't you kick us off on the retail to self-storage expertise that you have in that beautiful head of yours.
Yeah, looking forward to it. Good afternoon, everyone. Stephen, I actually had a follow-up question from a colleague that I was discussing it today, and they posed a question to me of the idea of buying these assets, refinance after 2 years and selling after 5 versus hanging on to them as a cash flowing asset for a longer period of time. And the question was really centered around the opportunity to do a 1031 exchange, needing every partner involved, the entire capital stack, to go into the next project for the 1031 versus pulling it
Yeah.
out.
Yeah, you can branch off. You can
Would
branch
you
off.
have to pursue tenancy in common prior to the sale of the property, or
No.
how do the logistics
No.
work for it?
Yeah, the syndication, so you'd have, you'd be basically as a general partner under an operating agreement within the entity which is holding the asset in question. And then everything is kind of divvied up in percentages from there. So once it's liquidated or sold or traded, whatever term what is related to, those shares would then be distributed accordingly. And at that point, each individual can then do what they want with their shares.
So then you'd have the opportunity to do a 1031 exchange and reinvest that to avoid the capital gains tax.
Precisely.
And then thus continue to make more money through the value add means versus purchasing an
Precisely.
underutilized asset and just stabilizing it again. Or
Some
Okay.
people want to cash out and pay their capital gains and make, pay their 27% and just have the cash and stack the cash. And some people want to redeploy into another high generating cash yield asset conversion like we're doing, because you have that accelerator of those returns that you don't have if you were to just liquidate, put in a savings account at 0.000% APR, 0.1%. Yeah.
so would the long-term goal be then to raise enough capital that you could just purchase an asset unleveraged and hold on to that as cash flowing, or
Always
just
leverage.
okay?
So if you can, and distribute that accordingly over, across 3 to 5 purchases, is maximize your leverage as much as possible.
And then
As
just
long as-
continue to roll those over every 5 years.
And then continue to roll those over every 5 years.
Okay, very, very cool.
And
thought
then you
it'd
put
be a
that
good
into a
question.
family trust. You put that into a family trust, and then you roll that over to your son, and then your son will then assume that family trust. And in that trust, you can put, the trustee can be in charge of running those assets and ensuring that those proceeds are being reinvested into new real estate. You can have that all outlined out, and it could go on forever. If you
Awesome.
wanted to.
Yeah, I had that question. I was not sure of the answer to it in regards to that 1031 exchange, but it's cool to understand that. I think it's
Yep.
great for the group to know, hey, what's the long-term play here as you get more of these properties that come through maturity and do that. So thank you for sharing.
Anytime.
So interesting property today, guys. This is actually one that I had looked at probably back in November, and we had to put it to rest. We were reaching out to the broker, and the broker assigned to this by the name of Jim was actually in charge of leasing out the property. The ownership group had given him 1 year to get this asset leased out, and we're going to kind of go through the particulars of it. We had issued an LOI and we were turned down quickly by the broker because his incentive was on the commissions from leasing this property versus the sale of it. And we were not able to make headway. Reached out to him several times to try to talk about, hey, what do you stand to make on this from a lease standpoint? Can we bake that into underwriting as far as a fee paid out to him so we keep him whole and try to motivate both the broker and the seller? Again, not able to make headway. As a last ditch effort, we went through skip tracing to attempt to find the owners and reach out to them. It's owned by an LLC with no named individual on there, so we weren't able to make contact with them either. And what recently happened is working through my broker network, they were able to bring this property up to me. And I'd mentioned, yes, I've been looking at this, but shared the story that I just shared with you guys and asked them, are you able to get a hold of the broker or the seller to be in favor of this? And they're like, yes, we've actually reached out and we're getting price guidance right now. It'll take about a week for them to reach back out to us, and I'll forward that on to you. And this really demonstrates the importance of creating relationships within real estate syndication and leveraging others to help find properties. The more brokers, owners, people that you can get involved with, demonstrate credibility, the more deal flow that you can generate, the more you're going to gain interest in these individuals that will promote deals. This is something Stephen has done very well with. I believe it's the Kabani Group, Stephen?
Yeah, Ahmed Kabani is a hotel broker with Marcus and Millichap, and they are probably one of the #1 brokerages in, Florida. And so built a relationship with the realtors and brokers in that office, and then just kind of leverage that over time.
Yeah. And that's, guys, that's how you work smarter versus harder. And you're able to find off-market listings, multiply your time, really find the best opportunities versus just scouting Crexi, CoStar, LoopNet, looking at listings that have been on there for 300, 600, 900 days that many people have taken a stab at, many people have approached. Now, don't get me wrong, there's a lot of opportunities to be found and had, and that's how we've gotten a lot of these ones that we presented out so far. But being able to leverage those outreaches, looking at these properties, identifying what you're looking for, and establishing that broker network goes a long way in finding new opportunities and accelerating your business. So for today, I have 1001 Hertel Avenue in Buffalo, New York. This is a former Kmart here, 2-star freestanding facility built in 1979, sitting on just under 11 acres and zoned as DS. So to give you guys a quick synopsis of the KPIs on this, we have a square foot per capita of 4.16 and 5.36 versus the state almanac of 2.97. So initially, upon looking at this, it would suggest that it's saturated for the state of New York. But New York, like California, has a wide diversity of population, city sizes, both rural areas and some of the largest cities in the world. So that number isn't always our North Star guiding principle when it comes to this. And this is when we will reach out to local competitors, identify their demands. We also have partners that are able to do a unique market analysis to discount both the distance and the class of the facility to see how much real impact would that have if we put it in there. But being far below the national average of 8 square foot per capita shows that there's a decent demand, especially amongst a larger population where you can see about 200 and 361,000 in the 3 and 5 mile radius. Median household income is in the fair to medium range, and we can see that this property will pencil at 3 million with a 25% IRR. While it's not above that 30 mark, with a 3.6 multiplier, it's still competitive when it comes to investors. With the debt market restricting and opportunities kind of waxing and waning, we'll take a look in the mid to high 20s. Anything over 30% is going to be ideal. And we're going to talk through different means of helping this project get more returns and utilizing it to its highest and best use. So we can see here just kind of a synopsis of the facility from CoStar, sitting at 91,000 square feet. Large facility. This is prime for self-storage. Once we start getting above 120, 150,000, it's going to stretch our ability to convert that asset. I've had 300,000 square foot warehouse buildings submitted to me where it's probably not going to be realistic to fill that all in with self-storage unless there's a major demand in that market that has not been met yet. Also, you can see here the assessed land value from the public record. I've kept this on the presentation just because it was part of my price guidance that was not shared with the broker as to what we need to come in at to meet the seller's needs. And the previous sale was not disclosed. Here, we're going to see a site plan where we can see the subject property, the freestanding Kmart right here amongst that 11-acre parking lot. Something that's exciting is the pylon that's already established on the property. It's going to give a lot of visibility to both of these roads that are seeing 13 and 25,000 cars per day. Fast casual dining, banks, other small retail supporting that will draw people in and create more visibility. And adjacent to it, you can see in the bottom of the screen here is a Kohl's, so going to be a high volume retailer. All these types of businesses are going to support more traffic through our business, giving us more visibility organically versus marketing and other means. And you can see too, just in the surrounding area, we're in a residential area, a lot of homes around here. So at first glance, both from the analytics, as well as the structure of the property and the location of it within the city, we're checking a lot of boxes here, and this is looking promising. Another representation of the site plan here, just to see how it sits amongst with the Kohl's, kind of the ingress egress of the property, where you can expect to come in. This becomes important with city planning when you discuss the conversion asset. Any kind of rezoning is going to require a site plan submission, showing things that will range from where the fire hydrants, where can emergency vehicles enter, to how is the traffic for this business going to flow? How's it going to impact the neighboring businesses? both the EDC and city planning want to see a really comprehensive plan as to what the final product will look like before they'll sign off on a special use permit, conditional use permit, or a full-on rezoning of that property. Getting just a visual of the building, you can see large vacant warehouse here or retail box. The outside of it appears to be in good condition, no major damage. After speaking with a broker, the roof is in good standing. There's no major deficits or deferred maintenance on the property. This all becomes very important in the CapEx and breaking out the costs beyond just the upgrades we plan to make from a self-storage point of view. I can tell you that bad parking lots can be very expensive. One property that we're still in negotiations with in Fairborn, Ohio, is looking at about 1.2 million in just repaving costs at $4 a square foot. And that's going to be absolutely necessary, not only for the city planning to feel comfortable about the conversion, but also to maintain that Class A facility that we seek to have. More exterior photos here. You can see the pylon, other parts of the building. This is just kind of the back lot, the side here where you can see the auto center that was once there. Everything looks pretty good. A small facelift, repainting the curves, restriping the parking lot will go a long way to making this look like new. We're going to dive into the demographics here. First thing we want to look at, pulled from Radius Plus here, is just a lay of the land from a 5-mile radius. We can see a pretty good density of competitors. And something to note is the blue circles within here. These are under construction. So while there are a lot of existing competitors in red here, and 5 or more new builds coming into the area, that can at first be a deterrent because, hey, there's more saturation within this, but it also suggests great growth and a need in that area. So I've had questions posed to me, hey, Nick, if there's a adjacent competitor, like you can see 2 right here, is that an area I want to stay away from? And my answer is no, not necessarily, because having adjacent competitors is going to draw more people of interest for self-storage into that area. At that point, it's going to come down to the state of that asset being a Class A, fully enclosed climate control facility, your rates, and even down to the service provided by your team there, and give that consumer an option to look at, hey, A, B, or C, where do I want to take my stuff? And again, going back to square foot per capita, we can see that there's a large demand that is not met in this area, hence why we're seeing so much new growth, not only under construction currently, but some of these dark green circles that have been built in the last several years. You can see Lincoln Self-Storage here highlighted at the bottom of the page. This is actually the comp I pulled for tax analysis. So when I'm scouting through Radius, one of the benefits is being able to understand what are the taxes of the competitors. I'll usually pull 3 to 4 depending and look to see what has the closest range. If you look at a smaller facility that's maybe 30,000 square feet, non-climate controlled, the taxes on that property might not be accurate compared to the facility that we're doing. So just like in multifamily, it's going to be very important to compare like to like. And in this demographic, with this 5-mile radius, this one was the closest at 197,000 square feet and 50% climate control. So taking a look at that taxes, you can expand this window out and it'll pull you into a whole different financial tab where you can see the tax assessment and everything else. Jumping into the rates here, we can see over the last several years, and again, the 10 by 10 being the most important or kind of the litmus test of that market, averaging 171. So again, a very high level or very high rent per square foot for these 10 by 10s. We can see it kind of peaking at 210 and dropping a little bit lower. This coincides with the popping up of new facilities. As there's more offers in the market, there will be commoditization where each provider is going to have to reduce their rates, increase promotional offers to try to pull more people in. Capturing market share is perhaps one of the most important things you can do in a ramping facility, because as someone parks their stuff there, they're likely to stay for the term of the need of that self-storage versus trying to move it over unless there's a gross gap in those two offerings. If someone's offering half or less on a rental basis, that's probably going to drive them to it. But if you think about the mindset of a consumer, once it's in there, you set it and forget it. This larger rental rate here at 171 is going to really help with any kind of penciling or CapEx. And we're going to dive into the unit mix and a little bit of the underwriting right here. On the left side of the screen, what you can see is a 5 by 10 all the way up to 10 by 20 for the climate controlled. The unit count per size where we're seeing the greatest density in that 10 by 10, 10 by 15, and the associated rates. Also in here, but not populated, would be RV and boat storage. In this city, they're open to the self-storage conversion, but against vehicle storage. So this is where we're going to start talking about how do you maximize the property in question. When you look at buying 11 acres and utilizing only the existing footprint of the building that's 91,000 square feet, there's a lot of cost basis that's not being utilized. So the first thing we think of that goes as a great complement for self-storage would be any kind of vehicle storage. And in a lot of retail spaces, this can be a challenge, not always, but that would be our first thing to look at because there's a huge ROI and a much smaller CapEx. For covered vehicle storage, we're looking at about $20 a square foot. That's where we come in, put a canopy up, and you're able to enclose that vehicle partially. And then we'll also have a mix of uncovered parking that's usually about $4 a square foot for CapEx. And then associated with anywhere from 30 to 70 cents a square foot based on uncovered and covered parking. Versus the self-storage units that are going to cost about $40 a square foot for those interior hallway units that we think of. On the right-hand side here, we can see where the price input was 3 million. And we'll get to the IRR as well as multiplier here in a second. And then we come down to the hard cost. Factored in here was $3.2 million for the internal conversion of that Kmart to the self-storage facility. What this is added up to is taking every unit times 40, or the square footage times $40 a square foot, and then multiplying that out. So that's where we get 3.2 million. And you can see in this case, the redevelopment of that site is actually exceeding the purchase price that we have here. And that's pretty often that we're spending more on the redevelopment of it than actual acquisition of the asset itself. This is going to produce a 25.5% IRR and a 3.6 multiplier. So still competitive, still something that will attract investors, but we definitely want to look at how can we sweeten this deal? How can we hedge against risk? And going back to the opportunities that we can do on the site is utilizing the remaining space on here. So something that actually helps with getting the city's approval for these conversions is a mixed use component. And with vehicle storage as not an option, the next thing I'll look at would be platting the parking lot and then subdividing it into pad sites along this main road here. So with this amount of space, we could look at adding 3 or even 4 pad sites that will range from 4,000 to maybe 6,000 square feet, similar to what you see here at the Dunkin' Donuts. We can look at fast casual dining, smaller retailers, things of that nature. And then in our underwriting, ideally what we would do is sell those off and let another developer come in to put up those pad sites, rent out those facilities and take advantage of it. A lot of times when you're scouting on Crexy and CoStar, you'll see pad sites for sale on these kind of major retailers, whether it's Walmart, Target, etc. And what that does for us is it allows us to get that return on investment, get that cash back into the final sale price, limit our holding costs of this 11 acres, and increase the value of this deal. By doing so, we can expect to see the IRR and multiplier go up. Typically, the IRR might be 1% to 3%. The multiplier will go up a little bit, maybe as much as a quarter or more. And then again, sweeten the deal. And the benefit of this is we don't have to manage those renters. We don't have to worry about the development costs. We can simplify the deal. Anytime you can keep a deal simplified, you're going to attract more attention, more investors that want to be involved because you're limiting risk and have a more strategic plan. Finally, on the right here, you can see the operating expenses. This is something we haven't really delved into, but we break it down from property management, payroll, utilities, everything on through, including insurance and property taxes. And this is where, the rubber really meets the road. The biggest swing you'll see on this is typically property taxes. Everything else in our equations are baked in based on the size of the asset, the number of units, et cetera. But the property taxes will have the impact on how much that percent of net revenues is going towards the operation of the asset. And that's going to impact the NOI, which will ultimately impact the final evaluation of the asset once stabilized. So at 29.7% here, it's on the low side for self-storage, depending on the region of the country. You'll see anywhere from 33 to about 39%. Things that can influence this is additional revenue streams that don't require additional management costs, light vehicle storage, or selling off those pad sites, things of that nature. But like I said, you can look up CRBE has a really good article that will kind of break down self-storage and kind of the different associated operation costs associated region by region. And again, to reiterate, 33 to about 39% is an ideal number. Anything north of that, we got to look at why is the expense so high? Is it directly associated with property taxes or some other calculation here? Anything below that, you might not be accurately depicting the revenue streams and NOI, and you want to make sure you check your math to make sure you're ready to go in when presenting to investors. That concludes the synopsis of this property here. We're coming up at the top of the hour, so I'll turn it back to the group for any kind of questions on this, feedback.
Great job, Nick.
Thank you. So there's your good news, Stephen. Hertel's back in play.
What's that again?
I said, there's your good news. That property's back in play. That was
I
one that,
was just, oh yeah, I was pretty excited about that. We've been working on that for a minute too.
yeah.
That's great. Travis, did you have a question?
Yeah, I was just, I'm curious about these two, investment opportunities. So I'm researching them pretty heavy here in Indy, and I just have questions to both of you about as I find. I think Nick and I have a call tomorrow, I think, or Saturday, I think, right? To talk about a project up north in Kokomo.
Yes.
Yeah. So I project listed for sale, and I'm just curious, as I can do a rough analysis before I do a deep underwriting, just the basic tools I need to plug and play real quick to quickly see if a deal is worth it or not without doing too much back end work. So hoping to gain insight on both those options for both the conversions to multifamily and conversions to storage. So
Yep, we can help with that.
yeah, good.
Yeah, we can talk through it on Saturday. The underwriting we demonstrate for you guys, we're fortunate enough to have a really good spreadsheet that once you understand it, you can plug it in pretty fast. There's other levels of knowledge of it that'll come in handy when you want to manipulate the acute variables. But we're able to assess properties relatively quickly and decide, hey, is this a go forward, or do we need to dock this one or pass on it?
You mentioned earlier, whenever you're talking about financing, you were looking, I think we were looking at that refi, that 2-year number at 75%. Is that because the bank that you use is automatically going to give you, requiring 25%, or is there an option, local bank here in Indy that I've discussed with will always give me 80% LTV. So is something you can also plug in there as well? Is that?
Yeah, it all comes down to leverage and the loan to cost that you can achieve with a lending institution. So that determines, the equity raise, but also the amount of money that will be returned back to investors. That certainly all has to, has an effect on the underwriting essentially. So, it comes into play when you're underwriting.
Okay.
Ideally, it'd be nice to get 100% of the capital that you've raised back to your investors. So therefore, that can either be redeployed back into the project or into other projects that you have that you're working on or working with. And so investors typically like a 2-year hold and the ability to get their money back in 2 years. It makes it just another makes the deal look even more attractive.
Understood. Next question I have quickly is the bank that I deal with mainly here, he doesn't want to deal with anyone who has any sort of syndication as part of the deal, just because he says it's kind of muddy as to who owns what, and who owns the majority is not necessarily, they don't have anything to help back that project. So they like to stay away from syndications. Have you found that as well in local banks, shining
I've
syndications?
first I've heard of it, and
Mhm.
pretty much all our projects are syndications. And so the loan sponsor is typically a high net worth individual who's willing to sign for said loan.
Right.
Is certainly part of the general partnership. But that's the first I've heard of a local.
That was a caveat. We need a big
Yeah.
KP on there as a GP just to offset it, because if there is no big KP, then he was talking about, I was talking about raising, the debt pay and the rehab cost and the down payment as part of a syndication, and without using a KP. So he said, bringing on a loan signer is the only way they'll get it done. Otherwise, they'll shy away from syndication.
Yeah, that's the only syndications I do, is I bring in a strong loan sponsor.
Okay. All right. Okay.
Cool. Any other questions? All right, top of the hour. I appreciate everyone joining, and until next Thursday, be nice to one another out there, and thanks for joining, and talk to you next week.
Have a great week, everyone.
Have a nice weekend. Bye now.